Hey folks, every stock market indicator is hinting to you that we are heading toward a correction, or dare I say it, a stock market crash. But wait a second, I would never make an investment strategy purely off trying to predict a market crash, because we all know time in the market yields much better returns than trying to time the market. However, these indicators have never really been wrong in the last 20 years, and I'm building my own little investment strategy to maybe take advantage of a correction we could see maybe in the coming year. So in the clarity of my transparency, I'm going to break down this strategy. We're going to go over the market indicators for you. So with all this homework I'm presenting, just hit that like button, folks, because we're going to kick it off by talking about the best indicator of them all, which is the Finra Statistics behind the margin in the stock market. This is every single account of people just margining their own debt into the stock market. And we need to go back first to the historical crashes of, let's say, the dot-com bubble in 2001 that reached its peak right around August of 2000, at which we saw about a 40% to 50% decline over the next several months. And going into these statistics, we got to scroll all the way back, baby, all the way to the 2000s. Which we can see here, guys, of August, between July and September, the market reached a margin peak of around $18 to $19 billion, at which when the bubble started to burst going into 2001, we saw the margin debt drop all the way down to $11 billion and then hit a very low sometime around the summer of 2001, where it bottomed out at about $8 billion. But let's skip ahead to the 2008 financial crisis, where the banks almost went bankrupt, and we saw the market drop again about 40 to 50%. If we just go take a look again at these Finra statistics here, guys, let's scroll all the way up to 2008 here. Going into the summer, we can see that margin debt was hovering anywhere from 37 billion to 45 billion at the absolute peak. And when that market burst again, guys, going toward December here, we can see it drop down to 23 billion. It literally dropped right in half and hit a low of 27 billion going into 2009. A low of 21 billion. So again, it cut right in half. This seems to happen in every single market cycle. So let's talk about the most recent market cycle, where we've seen this massive uptick in the market here, folks, because this is where things just get super fascinating. And we can even actually, let's first look at what happened going into the pandemic, because in the pandemic, which started around March of 2020, let's see where the margin debt was actually sitting at, because I wouldn't be surprised if we saw a little bit of a hiccup here. So as of March of 2020, where are we here? June, July, March of 2020. Here we go. We were sitting at about 479 billion. Yes, a lot has changed here, folks. And this was when the pandemic was announced. And we can see for the first time in almost any crash in history, the margin debt has actually gone up after the crash, not down, guys. We've seen a complete inverse from what has happened in the past. This is crazy, because in March, when the pandemic was announced, we saw margin debt go down slightly from 545 billion to 479. But ever since, margin debt has increased for the entire year, finishing 2020 at 778 billion. Look at where we sit now, from 798 billion going into 2021 to currently April of 2021 at 847 billion. That is an absurdly large increase, where most of it has only happened in the last year, exacerbated by the pandemic. This is absolutely terrifying if this does not level up, because we are sitting in a market with record low interest rates. And what happens, guys, if interest goes up a point, not only does it affect real estate, but it affects the stock market, these margin rates, and we might be going into another credit crunch where we see a mass deleverage of assets if interest rates decide to spike for whatever reason. But this isn't the only indicator, because many people are well aware of the PE ratio of the market cap, which is sitting at record highs it hasn't seen since the 2008 financial crisis, and that it hasn't seen since the 2001 dot-com bubble. And this is a really hard metric to wrap your mind around, because I know when we look at companies like Apple, Microsoft, Facebook, they are trading at higher premiums, but they are actually growing and have a fundamental base that kind of supports those higher PEs. But clearly there is another sector of the market driving the valuations up, because I mean, even Facebook only trades at a PE of 30, and yet the general S&P 500 index right now trades at a PE of 44, almost 25% higher than even the tech giants. Considering the median average has been around 14.85, like I said, these indicators, guys, have always said, hey, anytime this happens, just, keep your back up, because sometime in a year or 2 years, there could be a major market correction that comes from this. And it's just crazy when you look at the S&P 500 market cap, because it's gained most of its value, 30% of its value in under a year, currently sitting at 35.38 trillion. Most people don't even know what the value of the total S&P index indexes, and you can see just how fast it's ramped up since the pandemic has taken place. And some of this margin debt, maybe some house equity, because we don't know the full extent of how much margin is even in the market, because I use my line of credit. I don't use specific margin debt. So, and then you could even talk about, again, home line of credit equity that people leverage into the markets as well. So I really wouldn't be surprised at these record low interest rates if a lot of this is being held up to some degree by debt here, folks. So what do we do about this? Because there's no point stopping investing, because again, it's almost impossible to time a market crash. You can really only just put your foot on the brake. And Charlie Munger made a great point. He says, you know, you go back a year or two, it was like shooting fish in a barrel. You could have thrown money at anything and have made money. Now we're in a market where you got to be a lot more aggressive, you got to be a lot more diligent, and you got to be kind of digging around looking for those value plays, or maybe even some of those growth penny stocks that people are underlooking that are poised to have a really robust balance sheet grow in the near term. However, what I am personally doing, guys, is I've told you in my last video how I'm kind of structuring my buys, but more importantly, I'm really just stacking cash. I'm going to slowly start averaging into the market by adding some new tech giants, because I like Google where it currently sits. I still love Amazon, and it would really complement my Apple, Microsoft, Facebook, and Tesla position for the growth side of the portfolio. And I also want some higher yields coming out of the real estate, the REIT market. But I'm only doing that very cautiously, and I'm stepping slowly into it because I am very worried, based off these current statistics, that at any point in the next 6, 12, or maybe even 28, 24 months, there could be a very likelihood of a market correction, right? So I am aggressively stacking cash, and this is something that I think works better for me than maybe a newer investor, because I've already got a robust portfolio built out that is dripping, you know, a decent amount of dividends as well, which I am reinvesting those dividends immediately just to always be cost averaging into the market. But like I said, guys, I am by no means just being like shovel all your cash here, because it's just not the market we were previously in. I would not feel comfortable even buying an S&P 500 index here, because there's nothing saying that we don't go into a lull period where the market flatlines for a couple years. If you have a nice little emergency fund, I would do exactly what I've done and deleverage the risk in your portfolio as much as possible. And that's any kind of debt, margin debt that you have, because I have completely, many of you know at the beginning of the year, I was using a line of credit to kind of swing trade some stocks that worked out very well for me. But right now is not the time to have that much margin in the market, because if we do head into this indication of a correction, I'm going to have a ton of cash, and I'm going to have a ton of liquidity with my credit and my own personal margin, because I'm not using any of it right now. So I have access to a huge chunk of capital, and I'm going to get that poised and ready just in case. And then for the time being, just keep cost averaging into where I think the best stability for the next 3 to 5 or 10 years is going to be, and just kind of forget that a market crash could even happen, because that's just kind of what you have to do to balance a portfolio out. And at this point, I want to pass the question off to you. What are you guys doing with your portfolios? Have you looked into any of these metrics? Because they're absolutely horrifying, in my opinion, considering, again, every indicator in the past for margin has led to a crash, and 2020, first crash ever, where margin literally quadrupled. It's just insane. It's just insane. But love all of us. Let me know what you think in that comment section below. Stay cool, stay awesome, and I look forward to catching you tomorrow.